Hello everyone. My name is Hemant Kanawala and I manage equity investments at Kotak Life Insurance. Let me welcome you to this episode of Market Outlook by wishing you and your family a very happy and prosperous new year. May the year 2022 bring health, wealth and peace in your life. On the economic front, we are back to discussing COVID-19 and its new variant, Omicron. While the current wave of COVID-19 and emergence of Omicron variant suggests an onset of a large COVID wave, given the global data, it is anticipated that this will not lead to very high mortality and hospitalizations. Moreover, with 90% of eligible population receiving first dose of vaccine and 61% being fully vaccinated, the risk from the current wave remain contained. The governments are more prepared this time around and their policy responses are also guided by hospitalization rates and not caseload. Hence, we expect the downside risk to economic activity of the current wave to be muted. However, there is no room for complacency and urge all of you to follow policy guidelines issued by the government. Now, let us discuss some of the important policy developments around the globe and India. Monetary policy normalization continues to be the key theme, dominating the market sentiment globally, with US Federal Reserve pivoting towards an aggressive rate of tapering of bond purchases amid rising fears that inflation may not be transient. USA recorded a CPI inflation rate of about 5% consistently for last 6 months. Citing inflation fears, the Bank of England too hiked policy interest rates by 15 basis points, first time since the onset of pandemic. USA Fed is an important source of liquidity for global financial markets, and their tightening bias will have impact on valuation of risk assets. India is also expected to see continued monetary policy normalization, albeit gradually. With expectation that the economic and health impact of wave 3 of pandemic will be muted, MPC may embark upon normalization of policy rate corridor by early next financial year through hike in reverse repo rates, followed by repo rate hikes in FY23. This is likely to result in further increase in short-term rates. On government policy front, the focus continues to remain on revival of investment demand through continued infrastructure spending and policy support in the form of production-linked incentive schemes, that is PLIs. Government has allocated rupees 2 trillion in form of incentives for PLI, which is expected to create a minimum production of rupees 37.5 trillion and 10 million new jobs over 5 years. The minimum investment commitment sought by the companies applying for the PLI schemes is expected to be rupees 2.2 trillion with an upside potential of rupees 4 trillion over FY22-FY27. PLIs, along with the government support to housing sector, focus on energy transition, digitization and import substitution are already creating green shoots in investment demand in select sectors such as electronics, chemicals, textiles, pharma, data centers, EVs and new energy. The upcoming budget will be an important event to watch out for, as it will set tone for exit from crisis level fiscal support, and hence fiscal deficit number will be keenly watched. The budget is expected to remain focused on social and rural spending, creation of infra assets, and raising of resources through strategic divestments and national monetization pipeline. Equity market returns has been liquidity driven in last 2 years. However, that's set to change due to normalization of global and domestic monetary policy. We believe earnings performance will be a key trigger for the direction of the markets over next 5 to 6 quarters. So far, earnings recovery post-COVID has been strong with 24% Nifty EPS growth in FY21. Consensus is expecting the growth momentum to continue while expecting Nifty EPS to grow by around 20% year-on-year in Q3 FY22 and posting a 20% plus CAGR growth over FY21-24. While in near term, financials and IT will be key driver of earnings on account of low credit costs and ongoing digital transformation, contribution of consumption sector to earnings is expected to normalize over FY23 post a lull over last 4 to 5 quarters. 2021 was an interesting year in terms of flows, where FIs increasingly took money out from secondary markets with net outflows of $7.2 billion and investing in primary markets with net inflows of $10.8 billion, keeping total inflows at a moderate $3.7 billion. With mutual fund redemptions coming off along with strong SIP flows, mutual funds invested net $10.1 billion in Indian equities during the year. In backdrop of global liquidity withdrawal, FI inflows may remain moderate over next year with support from DII and mutual funds expected to continue. Nifty currently trades at 21.2 times on 12-month forward earnings, about 7% below the peak seen recently. The easing of valuations has been a combination of recent volatility in the markets on account of FI's outflow and mild upward revision in earnings. In current policy backdrop, we expect this trend to continue, where the valuations will see mean reversal driven by earnings, rollover and growth rather than price correction. Nifty has seen 11% CAGR returns over last 10 years and 20% CAGR over last 15 years. While near-term market may consolidate after posting strong gain over last 18 months, the long-term potential backed by strong earnings growth remains intact. Hence, investors should use any dips to increase allocation to equity. Thanks for watching the video. Please take care of yourself and your family members.